You're watching the China Show, and we're starting this morning with some breaking news that's just come from the Ministry of Commerce in Beijing. They are responding to this threat from President Trump overnight that if the US was, or if China was not prepared to drop their retaliatory tariffs, then he would put additional 50% duties on Chinese exports. China this morning, though, has just come out saying that they are vowing to defend their rights here. They're willing to take necessary actions, and actually that they will fight to the end.
Right, and the big question is, what is the end? That's what we've all been weighing. What is the end game here as well for Donald Trump?
Yeah, that's right. And just some of the other headlines that they're calling for dialogue. So they're looking for engagement with the US and Washington to try and resolve these disputes. I think it's very telling that since President Trump has been in the White House, he hasn't had any call yet with President Xi that we're aware of, at least. And so they are, again, looking to strongly oppose these tariffs, but still keeping that door open to some sort of negotiation.
Yeah, I think we had that comment from Fudan University professor who's basically saying, we've just been slapped in the face and you expect us to come to Washington and beg your pardon. So this is kind of the national approach to the face of tariffs, an increase beyond what is an effective 64% tariff on the Chinese goods.
Yeah, that's right. Okay, let's take a look at how it's feeding into market action so far this morning, because we're actually expecting some level of a bounce in Chinese equities. They were very hard hit in the session, and that extended overnight into the Golden Dragon Index, where we saw a further drop, and that was, again, because you had Trump coming out looking at these 50% additional levies on Chinese goods. This is really going to be sort of a bear market bounce. We can't expect it to sustain when you have this level of uncertainty. But again, when you take a look at how the Asian sentiment or session is broadly faring today, again, you have still very elevated volatility, but we do see some gauges rising in the session today. Japan actually is one of those that's leading so far if you take a look at the broader benchmark so far. But essentially Japan, we do have them also, again, being one of the first front runners to start some sort of negotiations with the Trump administration.
Yeah, I think the assessment here overnight and why the market turned a little bit is that it looks as though the Trump administration is offering carrots for those nations that are willing to take a conciliatory approach with the United States, and sticks for those vowing retaliation, aka China.
Yeah, all right, let's bring in our team now to cover all of these headlines. We've got our China correspondent, Min Lo, here with us in our studio. Joining us out of New York is Bloomberg Intelligence Chief Equity Strategist Gina Martin-Adams. But Min, we can start with you, because this is, again, as we said, MovCom just issuing these headlines just as we came into the show this morning. What are we hearing so far?
Yeah, I think this is the clearest message yet. China's Commerce Ministry saying, number one, they're going to fight to the end. So they're going to dig in their heels. They're not really going to remove the retaliatory tariffs that we just heard on Friday. And that's expected because Chinese policy making is very deliberative, pretty much the opposite of Trump. So very unlikely that they're going to reverse course days later. The second thing they're saying is they're still calling for dialogue. So they're not closing the door for dialogue. They're not looking to pick a fight with the U.S., but they just feel as if they don't have a choice now. As Steve, you mentioned, they feel like they are being slapped in the face. They have to hit back. And we also see that the Chinese embassy in the U.S. also responding that pressuring China is not the right way to engage with China. Beijing will only continue to take measures to protect the legitimate rights and interests. And also, one of the Chinese analysts that Bloomberg has interviewed, I think is pretty insightful. He's saying that China is patient. They're willing to wait this out because they believe that at some point Trump's efforts at these tariffs is going to fizzle out in momentum, especially given that he's facing pushback domestically as well. The White House having to come out to veto that bipartisan bill put forward by the Senate to limit to limit Trump's ability to impose tariffs.
So what else can China do for the next step to support its economy and its markets? We have Xi Jinping being quoted in state media as saying that he's going to fully unleash consumption. But at the same time, we're also getting a statement from the PBOC, essentially, that they're going to provide the lending support needed to the sovereign fund, Central Huijin Investments, to potentially buy ETFs further and bring in the national, to act as the national team to prop up stocks.
Yes, we actually got lines from various of these sovereign funds and state-backed funds saying they are pledging to continue to buy up these ETFs. As you said, the PBOC stepping in to provide relending facility to them. We also know policymakers met over the weekend to discuss potentially accelerating the implementation of fiscal stimulus, front-loading it. Some of these measures could include measures to support consumption, to support birth rates, providing subsidies. Morgan Stanley actually expecting we could see an imminent rate cut and triple R cut, 50 basis points this quarter, 10 to 15 basis point cut to the policy rates, potentially also maybe even expanding the fiscal deficit in the second half of this year. We already see the government front-loading the stimulus by speeding up the pace of government bond issuance so far. And of course, the next key date to look out for is the April Politburo meeting. That's when policymakers will meet. It's a policy, it's a window for more policy adjustments going forward. They might also expand that equipment subsidy program to maybe include even more goods and services as well. And we had the editorial on the People's Daily yesterday. The title is Focus on Doing Your Own Thing, and it urged governments at all levels to support companies to guide them to expand towards domestic consumption and to non-American markets as well.
Right.
Gina, we'll bring you in now. I'm taking a look at US futures and I'm not seeing too much of a reaction so far, but this is surely the biggest risk for investors, is that we continue to see these tensions between China and Washington ratcheting up.
Yeah, I would say that it's a big risk that not only we see tensions ratcheting up with China, but also tensions between the U.S. and the rest of the world continuing to ratchet higher. Clearly, we're already seeing downward directionality in terms of estimate revisions reflecting the tariffs. Over the course of just the last several weeks, analyst expectations for first half earnings in the 2025 year have dropped from double digits to single digits. First quarter, which we're kicking off just later this week, is expected to post just 6.7% earnings growth. It'll be the slowest pace of earnings growth in a year. So we're already starting to see downward momentum emerge for earnings, but I do fear that it's just the beginning, considering that we just got the tariffs finally announced last week. And so far, we've seen very little change or very little implementation in terms of any kind of negotiation lower across most of the world.
Gina, is there any indication that the Trump administration is listening to the chorus of influential money managers? Ken Griffin, the latest, saying it's a hefty tax on the middle class. Huge policy mistake. We've heard from the likes of Jamie Dimon and yesterday Nouriel Roubini. A number of different people have talked about this being potentially a policy mistake. But yet again, in the same time frame, we're seeing Donald Trump threatening an additional 50% tax tariff on China just now, as the Chinese Ministry of Commerce is saying, we're going to fight this to the end.
Yeah, I think you kind of answered your own question there in the midst of all of these sort of complaints. Trump is only making the trade war more extreme. So far, no, there does not appear to be a whole lot of listening. He's very committed to this path, this course of action. And unfortunately, U.S. companies are going to be part of the fallout of that course of action, as will U.S. consumers.
I mean, watching some of your earlier hits as well, and the things that you've been talking about on US programming as well, Gina, and I know that you're pretty laser focused on where the VIX is right now.
Yep.
How are you reading that? Above 40, of course, and where do you think that signals? If you take history as a guide, we see the later bottoming in markets.
Yeah, I think myself, as well as most investors, are now just looking for signs of capitulation, looking for signs of a bottoming formation. And the VIX is one of those indicators that most of us follow pretty carefully as a signal of volatility conditions. Of course, volatility conditions do tend to spike to extreme levels at or near major lows in the market. The problem with the VIX is it's a little bit of an unreliable narrator, as I say, in that VIX spikes can often occur toward the beginning of sell-offs as well as at the end. And especially they tend to occur fairly early in sell-offs that are affiliated with recession. So in an environment in which we're moving into recession, A VIX over 40, for example, emerged in 2001 and again emerged in 2008, well before the 2009 and 2000, late 2002 bottoms in stocks. So you could see this sort of really ugly climate continue, and that certainly has manifested itself in the VIX curve. The other things that we're watching are correlations and valuations as technical signals. I know valuation sounds like a fundamental signal, but there is kind of a magic number, if you will, on valuations of close to 15 times forward earnings. Tends to be where the market bottoms after periods of distress. We're at 18 times forward earnings, with forward earnings likely to go lower. Our real valuation level might be closer to 19, 20 times. So we're nowhere near those typical levels on valuations yet. And then the last thing that we watch is correlations. Pairwise correlations inside the equity market do tend to spike during periods of strain, tend to spike to at least 1.5 standard deviations above their long-term average before bottom formations emerge. So we've definitely seen some early signs of capitulation, but have we seen enough? Have we seen enough earnings estimate revision? Have we seen enough valuation compression to imply the low is in? We have very limited confidence in that.
Let's bring in again Min Lo. Let's talk about the other levers that the Chinese might have. One has been the weaponization of the yuan. Are depreciation trends growing?
Well, you look at what the last two sessions in terms of the fix had been. The PBOC said it just slightly higher, about 0.13% higher in each of those two sessions, but it's still keeping it below 7.2 yuan per dollar. And I think just looking at the signal so far, so much of the priority had been on stabilizing the stock market. All of these national team, the national sovereign funds stepping in to buy up the ETFs. We know that a part of the market sell-off yesterday was not just because of implications of tariffs on the economy, it's also around fears of depreciation, and aggressively depreciating the yuan is going to go against the PBOC's interest to stabilize the stock market. So I think it would be interesting to keep a close watch on what the next few days fix will be, whether the PBOC would slowly let the currency pair just float higher very gradually, or if they will continue to support the yuan while prioritizing stabilizing the stock market for now and using other measures to actually shore up the economy, ensure that capital continues to flow into the country and to boost domestic demand, while they also work on diversifying trade to other countries and other markets.
Right, that was our China correspondent Min Lo there, and also our Bloomberg Intelligence Chief Equity Strategist Gina Martin-Adams. Thanks very much for staying up for us in New York and taking a look at how Taiwan markets are coming online this morning, because of course they opened at the top of this hour and we're continuing to see that slide. You think about the trading activity that we had to start the week in Taiwan. It was a long weekend, so again it was sort of playing catch up to all of the tariff news, but we saw Taiwan's stock index tumbling by the most on record in the Monday session, even though you're seeing some sort of positivity in terms of how Japan is trading, Korea is trading. Taiwan, a very tech-heavy index, TSMC, the heaviest weighting on that, still in negative territory. But you think about the levies that are on semiconductor exports, excluded so far, but 32% tariff on Taiwan is among the highest in Asia.
Yeah, on top of what happened in Hong Kong, double-digit losses for the Hang Seng, for the Hang Seng Tech Index, the HSCEI. Catch up, yes, from Friday's sell-off. We'll have to see today.
All right.
Still ahead, we'll continue to talk tariffs and its impact on China with Eurasia Group, as well as Morgan Stanley. Chetan Ahya is going to join us. Also, Wang from Eurasia Group. China, obviously. M&G Investment joins us with their outlook as well for the markets amid the volatility we're seeing right now. And we are counting down to the open of trade in Shanghai, Shenzhen, and Hong Kong. Buckle up. This is China's Show.
You're watching The China Show, taking a look at the yuan reference rate that's just come out this morning. We're above the 720 handle. The estimate had been for 732.97, but still it's going to be very, very closely watched what the PBOC signals with the fixing given they're just walking such a tightrope? Do they want to have some sort of depreciation so they can try and overcome the tariff hurdle, or do they want to obviously let it strengthen? And then, it's a very difficult one for them to track. Yeah,
absolutely. And, there's been all kinds of different expectations from different pundits, some saying they could go 15% depreciation, or maybe 2 to 3% is more reasonable right now. We have to watch it because in trade war version 1, 2018-2019, the yuan depreciated by some 11% over 2 years. They've kept it stable this time, until now.
Let's bring in Fabiana Fedeli, CIO of Equities Multi-Asset and Sustainability, at M&G Investments. Thanks so much for joining us this morning in studio. And we can start with the yuan. What kind of strategy do you see officials taking, and what would be, I guess, the best approach when, again, we just had China at the top of the hour saying they're willing to fight these tariffs until the very end?
Good morning, Annabelle. It is difficult to say. I mean, the yuan has surprised us before. I wouldn't be surprised if we would get some level of depreciation going ahead, but not disorderly. I mean, it has always been kept very, very orderly in terms of control from the Chinese authorities. So possibly that control will continue. But it's obvious that China, President Xi and President Trump are likely to continue to have a very strong stance, at least publicly. Of course, the hope is that behind the curtains they are speaking.
Well, let's take a step back a little bit and see what your perspective is on the damaging effect of this. We've seen it actually be played out, obviously, in the markets over the last 3 days. But if this does not de-escalate this week, perhaps, what's the end result going to be? We don't see an end result yet.
If it doesn't de-escalate from a fundamental standpoint, let alone the sentiment standpoint, it is actually damaging to many companies. And as you know, particularly equities are driven by earnings. So if companies really don't have a way to hide in any country now because these tariffs are so wide, then it becomes more difficult for them to decide where to place their supply chains. This could all change in a minute if President Trump decides to renegotiate some tariffs. We saw what happened last night with the E-minis, that incredible turnaround when there was a news that one was not confirmed of potentially a reprieve.
Yeah, and I think that was a $2.5 trillion melt up in the space of 7 minutes. I mean, it really just tells you how there is such an increase in the speed and velocity of not just news in the markets, but also how equities are trading as well. So how are you advising then clients, and how are you looking at also making investment decisions when we just don't really know what's going to happen?
So, Annabelle, you made a very good point. Velocity in the market is increasing. We saw it even earlier in the year from the peak, even that first 10% correction that we saw in the S&P 500 was the 8th fastest since 1929. So as velocity is really picking up or starting to increase, it's very difficult to time this market. And also, because we don't know what the macro backdrop is going to be, we really need to look not at sweeping market bets, but more at specific company by company idiosyncratic changes. And one of the things that we've seen in the market yesterday, which was very different from last week, was indiscriminate selling. So many companies that probably are not going to be as affected by tariffs or are actually benefiting from other macro forces have been sold off, and that is an opportunity for active investors.
So there's the buying opportunity there.
Yes.
What are the data points you're going to be looking at specifically to see the health of the American economy as we're faced with this uncertainty going forward?
Confidence is key. So look at the confidence numbers of both corporates and consumers. Think about the Michigan survey, and also think about the new orders in the ISM data points. One very important, if you want, color that we got from one of the most recent ISM announcements was that corporates are either unable or unwilling to sign long-term contracts. That obviously is a very slippery slope.
In terms of the opportunities that you see, I saw some in your notes around defense stocks, for instance, in Europe. What other regions are you looking to? India, for instance?
So actually in Europe, because there is a stimulus package that has just been recently issued by the German government, so also based on a very, very healthy balance sheet, actually defense stocks are benefiting from something different, which is increased defense spending. But defense stocks have done very well already in Europe, despite some sell-off over the last day. So I wouldn't look specific at defense stocks, but all other stocks that could benefit from the increased infrastructure and defense spending. Think about utilities, think about consumer stocks that at the moment are very depressed. Other areas that we like are, for example, technology stocks, both in Asia and in the U.S. They've been very severely hit, but some of them continue to have very strong long-term fundamental prospects.
Well, what's your outlook then for China? Is it a wait and see, or are you encouraged that they do have levers of policy to potentially reflate the economy?
China has many levers to actually input in the economy. We believe we will see more stimulus, and so we still like domestic names. We just have to hope that at some point there's going to be a reprieve in the relationship with the U.S. That would be very important.
All right, Fabiana, thanks so much for joining us. That was Fabiana Fedeli there, CIO of Equities, Multi-Asset and Sustainability at M&G Investments. And yeah, we hope for a reprieve, but certainly if the news is however any indication, I mean, you can see it there at the bottom of the screen, China saying they're going to be fighting to the end. And we just got the first sort of indication in that in the yuan fix as well,
right,
because they allowed it to go above 720 for the first time since 2023. And you're seeing that market move off the back. It just sort of tells you, as you said, that tightrope. Weaker to allow that sort of competitiveness. Too weak, though, could anger Beijing or Washington, rather.
Yeah, I think the headline surfing continues for us the rest of this week.
Headline surfing, I like that. All right, we'll have plenty more ahead. You're watching the China show and also taking a look at pre-market. We are seeing the Hang Seng a little bit in positive territory, but more ahead. This is Bloomberg. We're a couple of minutes out from the open of markets this morning and still really passing over these headlines that dropped from the Ministry of Commerce at the top of the hour that China is saying they're going to be fighting to the end if the US insists on these new tariffs. So we are seeing futures pointing to some modest gains at the open. But remember, of course, these markets have sold off heavily, and this really could just be a bear market bounce, essentially. Some of the stocks that we're going to be tracking in the session in particular today, we're taking a look first at the biggest decliners yesterday in the session. So you had the likes of BYD, for instance. Geely also under pressure. What's very interesting as well is going to be how President Xi navigates relationships with countries in this part of the world as well. Is there going to be any level of frustration that if China can't export to the US, are you going to have countries that are as well concerned about China trying to export overcapacity in this region? And actually BYD is saying that they've knocked back investment from BYD into the country.
So Xi's visit to Southeast Asia at the end of this month takes on added importance.
Absolutely. And also some of the big tech stocks. Again, as we approach the open, we'll have plenty more ahead. This is Bloomberg.
And welcome back. You're watching the China Show. We're counting down to the open of the markets.
Yeah, and Steve, I mean, if you've taken futures as any sort of indication, we are going to see some level of positivity in the session today, but many strategists would tell you really beware of this one. This could just be a bear market bounce, similar to what we're seeing in other markets. The Nikkei, for instance, today climbing more than 5% so far. Look, it's been a very, very interesting start to the show today because we had a very strong rebuke or pushback from China just at the top of this hour, really talking about these tariffs that Trump threatened overnight.
Yeah, that's right. And the move is in your court now, Donald Trump. Back and forth, tit for tat. See how far this one goes, obviously. To the end, if they're going to fight, we simply don't know.
Yeah, that's right. So taking a look at how markets are coming online this morning, again, you can see the CSI 300 moving a little bit higher, quarter of a percentage point. We are opening, of course, after the worst drop that we've seen for equity markets going all the way back to 1998. But as I said, some of these headlines that have crossed. So we saw overnight Donald Trump saying that if China did not repeal its reciprocal tariffs on the US, then it would be issuing additional 50% duties on top. China, though, as we said at the top of this hour, pushing back on that and saying that they will fight until the very end on this. So, again, it just really tells us how much volatility we can expect, and also taking a look at the different levers that they can pull. And one of the very interesting ones to watch this hour has been what China has done with the yuan, allowing the fix to weaken past the 7.2 level for the first time going back to 2023. Again, this is the start of what we see here, taking a look at that benchmark 10-year yield there as well, because we're tracking back down to record lows for it. Though we are seeing, again, some of the consumer names, Motai, for instance, a little bit higher. And we did see President Xi Jinping vowing to try and boost consumption. CATL again, and Midea, another consumer name. But let's take a look at what's happening in Hong Kong. And again, recapping some of these lines around the currency in particular, because we did see at the 7.2 or above that 7.2 level on the fix. You can see here we have seen the currency moving off that. Again, Jeffries is saying, for instance, that they now see a 75% risk or odds of depreciation of that. And they're saying that if we do see depreciation, expect Beijing to go big on this to the magnitude of around 20, 30%. Again, how Beijing possibly could handle this tariff risk. A lot of green here. You can see HS Tech standing out in particular. We've got gains there of more than 4%, but names like Tencent, Alibaba, Baidu, Meituan, Xiaomi, rising nearly 6%. Apple suppliers, again, we saw these under pressure in the session yesterday, and there was some Wall Street Journal reporting overnight that essentially Apple could look to produce more of its or manufacture more of its iPhones in India. We already see them doing that with certain models, but that, again, could be a risk to some of these names, and they actually are underperforming really very much the market. Also taking a look at some buybacks that are in play today, because we have two that we're focusing on. Zijin Mining is one and Guotai Haitong another, but again, both of these companies are planning buybacks. Guotai Haitong there up to 1 billion to 2 billion yuan, Steve.
All right, let's get a look at the China market. Let's bring in Bloomberg Equity senior reporter Abhishek Vishnoi, joins us now from Singapore. So Abhishek, a lot has happened in the last 24 hours. The markets are bouncing back, and maybe some of those recession fears pulling back a little bit. Maybe it's just a bounce from the big selling we had yesterday. What's your read right now, first blush?
That's right. It looks like a rebound from extremely oversold levels, and it's not very different from what we had seen in the US. So it's of paramount importance to see how the session progresses and where the market closes. But one thing to note here is, both these economies, US and China, are digging heels to fight a prolonged and probably disruptive trade war, which is going to get priced in. So the setup for the long term does not look good. And the odds of, the green that we are seeing on the screen being just a temporary bounce are on the higher side. Now, China, versus US looks a relatively better bet, not just because of valuations, but alongside, its escalation of this trade war, it is also doubling down on the stimulus efforts that it plans to do. The authorities are planning to front-load stimulus, right from rate cuts to RR cuts to more spending to boost consumption. And amid this whole playbook, direct intervention by state-backed funds have also increased. We have been reporting since yesterday how some ETFs that are preferred by the national team are seeing great volumes. Some of the sovereign wealth funds and other funds that are backed by China have come in the market and pledged to keep buying ETFs, tech stocks, and state-oriented companies from the market. So that is also providing some sort of support. more often than not, that helps the sentiment on the marginal side. And it's, you have to look at it as a package of that whole front loading of stimulus that China is planning. Now, this also underscores one very important thing. It's to do with, how governments or fiscal spending is actually becoming the primary force of driving markets, not central banks. So, the Fed pause is there in the backdrop, but a lot would depend on what the governments do, what the governments of US and China do, then central banks on Fed this time to see where the markets are headed.
Abhishek, I want to mention as well, we've just seen the offshore yuan falling to its weakest since 2023. And to mention that as well, because we had the yuan fix earlier in this hour above that 7.2 level for the first time to September 2023. But there we go. You can see there a bit of the currency move off the back. Again, you talk about sort of these arsenals that Beijing or levers that Beijing can pull on currency depreciation could be one. Abhishek, from the businesses that you're talking to and the investors, rather, that you're talking to, it has been very indiscriminate selling so far. And a lot of the Chinese names like Alibaba or Tencent, for instance, they're still very domestically oriented. So where are people seeing the opportunities right now?
I mean, that's right. I mean, a lot of stimulus is coming, and depreciation would be part of the whole package. Now, in terms of, calls, I mean, if you look at the Asia equity setup, there were two very big themes. One was obviously China, before the DeepSeek thing happened. One was China, and the other bucket was China plus one. Now, what our reporting is showing is a lot of fund managers are actually a lot more comfortable with local China than the China plus one theme. Now, remember, China plus one theme encompasses ASEAN, it encompasses India, it encompasses all those economies that, were helping US and China to balance out their relationship and trade, sourcing goods without getting into the eye of each other. That theme is breaking down a lot more because the tariffs have been blanket wide from Trump's side. But for China, there are a lot of things at work. You've got the DeepSeek afterglow. You've got valuations on the side. You've got commitment of a lot of, local stimulus. So all these things are sort of, balancing out things in favor of China. What is yet to be seen, though, is that this is a market meltdown that we witnessed yesterday, and it's evoking memories not just of Hong Kong being at lowest since 1998, 1997, but in US also there were a lot of comparisons made with the Black Monday crash of 1987. So with these kind of crash, it's usually a breakdown. It's a breakdown of sentiment. It's a change of long-term trend. So what we have to see is whether rallies sustain and we get a sort of soft grind upwards, a sideways movement. That might be better. That might actually lay the bedrock for next move. But if that doesn't happen, then this year would set up for being a negative year for most markets.
That was our Bloomberg equity senior reporter Abhishek Vishnoi there. And just to mention as well, and my apologies, it was the onshore yuan that has fallen to the weakest since 2023. But still, we have seen, again, moves in the offshore, and it is going back to the yuan fix earlier today above that 7.2 mark for the first time since 2023 as well.
Let's further that discussion. Of course, let's bring in Dan Wang, China Director at Eurasia Group. Don, thanks for joining us. So the yuan right now seems to be a lever that the Beijing authorities are looking at pulling right now as the trade war intensifies. What's the likelihood we're going to see a sizable depreciation of the CNY and CNH against the dollar?
I don't see much of a likelihood in that direction because it's not in China's best interest. So right now, it would be weird if the central bank doesn't respond this way because it has to allow more of volatility within that 7 to 7.3 range to counter the tariff pressure. But a bigger worry for the central bank has been the capital flight. And what if this devaluation expectation is embedded in the financial market? Just imagine that is not a weapon actually for China to use. It's more like a financial suicide if China let the market believe it will let yuan slide.
Okay, financial suicide. I mean, you can't put it more strongly there, even though we do have names like Jeffries, for instance, saying there's a 75% chance now of devaluation. So talk us through then the conversations you've been having with people in China over the past couple of days and sort of the sentiment or messages that you're hearing.
Well, a lot of people do worry that at some point maybe the central bank could let yuan slide if the pressure from the U.S. is getting too big. This 50% or even 60% of tariff, if actually become true, that's an essential decoupling of China's supply chain from the rest of the world, and that's detrimental. And in that situation, I still believe the central bank will try its best, and it has the credibility to actually defend the yuan. Just think about that 3 trillion foreign reserve. Technically, China's central bank can fix the yuan at any point it wants. And one more point to that, at this point, the bilateral trade between China and the U.S. is not the most important one for China. The trade relations with its other trading partners is way more important. And there is a lot of hostility towards Chinese export in the past few years. It's about dumping or crowding out the local industries, especially in auto or in the green industry. So for China to improve the bilateral relations with other trading partners, it's a much bigger concern. So maintain a stable yuan or even revalue it against dollar at some point is really to China's best interest.
Well, Don, how active must the national team, whether it's Central Huijin Investment, the Sovereign Fund, and others, to prop up not only the markets but to prop up sentiment?
Well, they're quite crucial, and people have been waiting for this. Although Central Huijin's action, as you have seen, didn't yield much of an impact on the stock market. It didn't reverse that downward trend. But the fact that the national team is ready and there will be more to come is a bolster for the market confidence. And to invest in Chinese stock market, the rationale behind it is quite different from investing in other market. Chinese stock market is quite isolated from the rest of the world and highly controlled. And many people see it as a breeder for future good companies. And China is producing some of the world's leading companies now. And for anyone who's having an eye on China, they probably are viewing like automation, AI, or whatever transformative technology for the future. So the investors, after this round of panic mode, probably will return to Chinese market. I actually see less of a chance of Chinese stock market slide much this year. It could very much likely to outperform.
Well, that's where I was going to go next, Don. You believe that the markets will outperform despite all this negative sentiment right now. So end of the year, we're talking maybe S&P down and the CSI 300 up. That would be quite a prediction.
Well, it's all in relative terms. So previously, people didn't have this expectation that the dollar might be weak in the midterm, and that yuan might be strong. And also, relatively speaking, Chinese domestic economy is in a more stable mode than the U.S. There is a high chance that the U.S. will enter a recessionary period. But for China, reaching the 5% of GDP growth target is still very much likely for the government and also for the general public to believe. So one thing I want to point out is China as a producer for this world is in a much stronger position at this point because demand can be generated out of thin air, but supply is real. You have to actually invest to be able to produce a lot of the stuff. So although the U.S. is imposing more tariffs on China now, but one way or another, it has to pay for a big portion of that cost. And the fact that Chinese yuan is maintaining a relative strong position against dollar is imposing part of that cost onto the U.S. buyers. So going forward, there will be a bigger pressure on the U.S. Than on China.
What do you think, though, Dan, about sort of some of the headlines that we're already seeing? For instance, Wall Street Journal had reporting that Apple will now look to manufacture more of their phones inside India as opposed to China to try and offset the tariffs. You've had as well India. We had an interview overnight with the Commerce Minister talking about how they've rejected investment from BYD. Again, that points back to what you were mentioning there around the relationship that Beijing has with trading partners in this region as well and the need to work on that. Where do you see these impacts for China in particular, if not to GDP, then things like employment?
Well, this will be a big blow for Chinese employment, but it will be very concentrated in export sector. And the 40% or 50% of tariffs won't be as detrimental, actually, when it comes to how many jobs it can destroy by revoking the $800 de minimis rule, because that's the bulk part of the export sector's employment. And those small producers do not have the means to shift their supply chain overseas. They also do not have the access to commercial banks to get cheap loans like those large producers are. So employment is a big problem. The Chinese government has been preparing for this. There are different arrangements to give tax rebate or cheaper utilities, but I guess it's only to buy more time. Eventually, there has to be a new market for those sellers. And there are a lot of talks about Chinese supply chain has to be further diversified to areas like India, Latin America. But those places, even accounting for the tariffs, in Southeast Asia are not in a better position to be a production center. So Southeast Asia as a manufacturing center, I don't see its position being shaken by those tariffs. And China is only at the initial phase of trying to get more companies to invest overseas. And the global market will eventually be much more important to China than the domestic market. And we're only seeing the start of it.
All right, Dan Wang, China Director at Eurasia Group. Always good to get your insights on this critical week, obviously. For more on the impact of tariffs, you can read our Big Take piece today. It discusses how investors and businesses are being caught in the middle of Trump's America First policies and profound changes in China's economy. That story is on the terminal. You can also read it on Bloomberg.com. There's plenty more ahead. This is The China Show, and this is Bloomberg.
We're just over 15 minutes into the session so far. Chinese equities are moving a little bit higher in the session, but again, we don't want to get too enthusiastic just yet, because there's a lot of people out there that would say this really could just be a bit of a head fake.
Yeah, that's right. I mean, look, the markets really did respond yesterday to the downside. We had the Hang Seng Tech Index down 17%, the 8-share index down 13.7%, the Hang Seng down 13%. Really a bear market bounce from Thursday and Friday of last week, getting a little bit of a reprieve. Be careful, though.
And at the same time, you've got investors that are, again, really thinking around how much the Fed can move. You're taking a look here at market pricing of what's being implied at this point. But essentially, trade is sort of fluctuating between 3 and 5 quarter-point cuts this year. And just to note as well, Deutsche Bank, which could be among the first actually to have put out some sort of upgrade, but essentially they're now seeing the RBA cutting 50 basis points at their May meeting, and that was before 25 basis points.
Yeah, that's right. All right, Bloomberg opinion columnist and former New York Fed President Bill Dudley says the central bank, the Fed, is unlikely to step in and rescue the U.S. economy from the damage caused by President Trump's tariffs. He says the Fed will only intervene if markets stop working.
The problem is that they're going to be missing on both sides of their dual mandate objectives. Inflation is going to go up. Growth is going to go down, the unemployment rate is going to move up. And so the question is, how do you balance those two things? I think it's more difficult to balance in the current environment because the Fed has been missing its inflation target to the upside. This will be the 5th year in a row that inflation will run above the Fed's 2% objective. And in that kind of situation, Fed has to be awfully concerned that if they try to follow a too friendly approach, inflation expectations become unanchored, and we're back like the experience that we had in the 1970s under Arthur Burns. If you remember, in the 1970s, we had these two oil price shocks. Oil prices went from around $3 a barrel to 10, and then from 10 to around 30. And these supply shocks were different because they were persistent. I think the situation today is similar in some respects because I think tariffs are going up and they're going to stay up for quite a long time. So it's not like a temporary supply disruption like we had during the COVID pandemic.
Now, one question I have, to your point on the COVID pandemic, you had the Fed step in drastically. For the market watchers who are market participants, frankly, who are hoping for the Fed to step in, potentially even with an intermeeting cut, what do you tell them?
Well, I think the COVID pandemic was quite different, right? Because COVID pandemic was bad for growth and was pushing down inflation. So it also caused massive market disruption, especially in the U.S. Treasury market. So the Fed had reason to respond, both because of their dual mandate objectives, but also because of market dysfunction. Now, obviously, if the markets start to break down in some fundamental way where liquidity, just starts to dry up, then I think the Fed might have to do something in terms of market intervention. But that's different than the monetary policy choices. And I think what Powell was saying on last week was, we have to concentrate on both sides of our dual mandate objectives, both inflation and unemployment. I mean, one way to look at this is the Taylor rule. The Taylor rule basically is a way of encapsulating how the Fed takes both inflation and unemployment in perspective. So let's imagine 6 months from now, inflation's 5% and the unemployment rate is 5%. In that environment, the Taylor rule would tell you that the federal funds rate should be about where it is today.
That's Bill Dudley there, Bloomberg opinion columnist and former New York Fed President. If you're a Bloomberg subscriber, you can catch up with all of our interviews by using our interactive function, TV Go. You can also join the conversation by sending instant messages to our team and to our guests during our live shows. Check it out at TV Go. We'll have plenty more ahead. This is Bloomberg.
And welcome back to the China Show. Quickly, we have a headline coming across the Bloomberg terminal. Taiwan is having ongoing talks with the United States on the tariffs. That's according to the Taiwan premier. So again, we are seeing a number of different nations willing to talk, try and reach some common ground with the United States on the tariffs, while China is digging in its heels.
Yeah, that's right. And actually, Taiwan amongst the hardest hit by duties, and certainly something that caught investors off guard that you can see here under pressure still. Taking a look at some of the consumer stocks as well in China this morning, given we've had President Xi vowing to boost consumption or to spur consumption. We are seeing some gains here for names, but again, we're not seeing really outsized moves just yet either, given there's so much uncertainty and this big pushback from Beijing at the top of the hour.
Yeah, that's right. Just to highlight again, Taiwan has 32% tariff from the United States.
Welcome back to the China Show. Taking a look at how Hong Kong is faring half an hour into the session so far today, and we are seeing some upside, but you put it in the context of the extreme selling activity that we've seen over the past couple of sessions, and this obviously could just be sort of a bear market bounce that we keep talking about. China as well, something that really entered the fray an hour ago was China saying that they would be vowing to fight to the end if the US insists on these new tariffs as well.
Digging in the heels. We're seeing it both in Washington and in Beijing, while others, including Taiwan, having talks with the Trump administration.
All right, taking a look as well at how broader markets are faring so far in the session. Indonesia, for instance, that's another benchmark that just gets online with trading this morning. We are seeing as well this market coming back from what has been an extended holiday break. And we do see it again, a drop of nearly 10% there for the benchmark. Of course, a bit of catch down. But Indonesia, one of the ones that has been highlighted maybe as being a little bit more domestically and insulated. But this is the broader picture here, and we are seeing again stocks moving a little higher. We've got the dollar a little under pressure, yields not doing too much, but certainly we are rethinking as well Fed expectations, and traders really caught between say 3 and 5 quarter point cuts this year. And actually we had the RBA saying as well, or rather economists from Deutsche Bank saying that the RBA could move by 50 basis points instead of 25 that they had earlier forecast for May.
The way the headlines are coming these days, May seems like a long way off.
Very true as well. All right, let's get more on how the markets are digesting the latest tariff news. Bring on our MLI strategist, Mark Cranfield, with us this morning. And Mark, I guess the question can be, how long do you expect this to last? The small moves that we're seeing to the upside today.
Well, it's right that you start talking about central banks and specifically the Federal Reserve, because the way investors are, the nerves are very high. Markets are very dislocated. And what we've been used to over the past couple of decades is that when we get into this kind of situation, it's the central banks who blink first, and they start lowering interest rates to try and smooth the way in markets and to make people feel better. So this week we've got the Reserve Bank of New Zealand and the Reserve Bank of India. Both are expected to lower interest rates, possibly even by larger amounts than 25 basis points, which is the standard. People may be speculating on that. I see a headline just before I came on TV that one bank is now expecting the RBA to lower rates by 50 basis points at its next meeting. I think what you can assume is that all central bank meetings around the world from here onwards are live. Everybody will be expecting the possibility of a decision, particularly for lowering interest rates, whoever is meeting. Although the Federal Reserve meeting is about a month away, even by the time we get to that, there could be pressure building on the Federal Reserve to lower interest rates, even though Fed speakers have been pretty resistant. We just heard again last night from Mr. Gooseby. He seems to be one of those who wants more time to assess the data, upside risks to inflation as well. But things are moving so quickly. You can see it's a very fluid situation. Look at the size of equity market moves in a very short period. 1 month is a very, very long time in financial markets at the moment. By the time we get to the first week of May, things, if they haven't improved, the Federal Reserve may even have to look at lowering interest rates reluctantly, because they have warned that there's a stagflationary situation building. But at the same time, consumer confidence is crashing. People are downgrading growth outlooks. They're even talking about a recession in the United States. All of that will be on the radar of the Federal Reserve. Central banks are very much in play, and that's what investors want to hear from.
And Mark, just to mention as well, we're just seeing a trading halt in Indonesia. The benchmark there has fallen more than 9%. It was shut for a public holiday, so it is catching down to all of these tariff announcements. But it really is, you said, Steve, I think to the point that you made that, yeah, May might seem like a long time away, just given how much these headlines are dropping. And one of the key ones that we were tracking in the last hour, at least, was China pushing back on these tariffs, and also China with their currency fix and above 7.2.
Yeah, that's right. So, Mark, I just wanted to ask you about the yuan. What are you hearing about whether this could be the next lever of retaliation or actually support for the market? Don Wang was on with us just a few minutes ago saying it would be suicide to let it depreciate too much, but we had Jeffries and others saying this could go even further. What are you hearing?
I think if you look at the way they've shifted the fixing for the last 3 sessions, it's a very calibrated but clear reminder that yuan is one of the tools that the Chinese authorities can use if they want to play hardball in the tariff world. People are beginning to look back at the measures in 2018, 2019, when Donald Trump in his first administration imposed tariffs on China. Traders saw how the central bank in China gradually lifted the daily fixing rate until dollar yuan was significantly higher, about 60 big figures higher. That's a huge move. In percentage terms, it pretty much matched the kind of tariffs United were imposing. If they do anything like that this time around, and it's very early stages, we would be looking at dollar yuan above 8. And that would really be a shock to the global financial system. But you can see the PBOC moves it a little bit. They come in and they modify trading on a day-to-day basis. But those 3 shifts, successive shifts in the daily fixing, are significant. They're large by Chinese standards. People were getting used to movements of just 1 or 2 basis points a day. We've seen 100 basis points clips coming in. That's a very big message to people. Don't forget, we have a currency that influences the whole world. We can use it if we want to. It's not a full-blown threat yet, but the messaging is very, very clear. They can and they will shift the yuan if they need to.
Yeah, and I think some were saying we could see depreciation of around 30%, but that was our Bloomberg M-Life strategist, Mark Cranfield, there. And as we said, it's really about trying to determine what levers China wants to pull in this. And as we heard at the top of the last hour, that they're vowing to fight to the end on this one as well if the US insists on imposing new tariffs. Now, it does come after President Trump threatened to slap an additional 50% duties on Chinese goods following Beijing's response to Washington's reciprocal levies as well. But let's get more with our roundtable. Min Lo and our news desk editor Jill Deese is joining us now. So Min, recap for us what we've been hearing from China this morning.
Yeah, I mean, look, so the U.S. is planning to impose an additional 50% tariff on Chinese goods. If you take it all in, that brings the total tariffs to over 150%. It will essentially decimate all bilateral trade between U.S. and China. We're less than 24 hours away from the end of that deadline for that ultimatum to pass. And China hasn't made any concrete actions to repeal the retaliatory tariffs, but they're also at the same time not adding fuel to fire. They're not taking additional countermeasures so far. They're essentially in this hunker down and fight mode. There was the headline in yesterday's editorial, focus on doing your own thing. So they're putting all their resources on managing the fallout in the domestic economy, taking extraordinary measures to support the economy. They are not closing the door to negotiations that was very clearly mentioned this morning from Commerce Ministry, saying they are still calling for dialogue. But at the same time, they are not knocking the they're not knocking down the door trying to get to the negotiation table with the U.S. as well. They're not urgent about it.
Well, Xi Jinping, as quoted in the state media, is talking about fully unleashing the consumer. So obviously the levers at their disposal right now, as they dig in their heels externally, domestically, they need to prop up the economy because there are going to be shocks.
Yes, obviously they can't rely so much on trade with the U.S. and they are prepared for this moment because the amount of exports that China has to the U.S. has declined from about 17 or 19% now down to about just 15% of their total exports. And China is certainly going to try to diversify their trade even further. We know that President Xi has been reported by ASEAN that he is going to visit countries like Malaysia, Cambodia, Vietnam. Sometime in mid-April, he'll be sure to make a pitch to these Southeast Asian countries to try to deepen trade ties with some of these countries and also get a sense of what sort of carrots, if you will, that these countries would offer to the U.S. in exchange for lower tariffs and ensuring that these wouldn't undercut Chinese interests. And of course, domestically, they might be looking at accelerating or front-loading the stimulus measures this year. We already see part of that happening with the speeding up of the issuance of local government bonds. Interest rate cuts, triple R cuts, that could be coming imminently as well. It's been flagged several times before. Morgan Stanley expecting a 50 basis point cut to the triple R and 10 to 15 basis point cut to the policy rates, possibly more relaxation of the home buying measures, expansion of that subsidy program to include more subsidies for other goods and services. And yes, as Mark Cranfield said, maybe lowering that, weakening the yuan gradually to blunt the impact of tariffs.
Well, Jill, I think we can bring you in. You know, this headline only came out in the last hour, so we haven't had any sort of reaction from DC yet. But just gauging the tone that President Trump was making overnight, it's not going to be exactly well received either.
No, I mean, I think what's really interesting here is you're seeing a different approach between the way that Beijing is reacting to these tariffs versus a lot of other parts of the world, right? So Beijing, obviously, as Minmin was explaining, doubling down, really kind of digging in their heels, really showing that, you know, they don't want to bow to these types of threats from Trump. And that's where you're seeing this escalation in this trade war between the U.S. and China. I think you take that in contrast to the approach from a lot of other governments, including Japan, where the Prime Minister Ishiba just the other day was basically saying, you know, they don't really know why exactly they're the target of this. You know, they're a U.S. ally. They were just slapped with these 24% reciprocal tariffs that go into effect tomorrow, in addition to this 25% autos tariff that's really hitting them. You also saw Israel's Bibi Netanyahu in the White House yesterday, you know, also a U.S. ally, wondering why exactly they've been hit with tariffs. Really does kind of show that difference between China, which, you know, I mean, obviously already has somewhat of an adversarial relationship geopolitically with the U.S. versus these other, you know, these other nations where, you know, it's really difficult for them to kind of tell how exactly you really respond to these tariffs. I mean, a lot of this was set off of deficit levels, right, rather than like the actual real reciprocal tariffs that, you know, Trump is claiming that these countries are set on them. And so it becomes really difficult for certain countries to figure out how to negotiate and ultimately work with Trump here.
Does this point to maybe deficiencies in the China policies of the new administration in Washington? I've covered China for 35 years. Anytime there's a gun put to China's head, they dig in their heels and there's resistance. It's different. They respond differently to what basically assaults to their face. So what's the next move, I guess, for the Trump administration?
I think that's so difficult to tell, right, Steve? I mean, yes, like, I mean, we we saw this during the first Trump administration, right? We saw that, ultimately we entered a trade war. And we saw that kind of continue through to the Biden administration, sort of stepping in and continuing to try to, implement various, punitive measures on China, whether that was sanctions, trying to stop them from, pursuing advanced technologies. And we've seen China, ultimately try to work around this as much as possible. I mean, they've, continued to try to, really build into advanced technologies. I think that, in this whole, this latest tariffs war, I mean, you can see, for example, China really kind of, reaching out to a lot of other nations that have been targeted with these reciprocal tariffs by Trump, including in, Southeast Asia, trying to make inroads there to build their influence. I think it leaves the Trump administration in a really interesting spot. But I'm not sure exactly how you get out of this other than this continued, sort of rhetoric building back and forth here. I think ultimately, though, when you've got China saying, we're, going to bring the fight to you, essentially, when you've got Trump threatening even higher tariffs, it does seem like, a potential talk between Xi Jinping and Donald Trump just seems further and further away.
Yesterday, people were talking about this as a high-stakes game of chicken right now. Who de-escalates first, right? All right, Jill Deeses, thanks so much for your insight, and also, of course, our China correspondent, Min Lo. Still ahead on the China Show, we look at what Trump's tariffs will mean for China. Heck, that's what we've been discussing all morning long. And we will have that with Morgan Stanley's Chetan Ahya coming up as Beijing vows to fight U.S. duties to the end. That's next. This is Bloomberg.
The two-year yield is screaming. I think it's screaming at the Fed. I think it's screaming at global central banks.
There is not an external pressure catalyst on President Trump right now to pull these tariffs back. And we should operate as though they are real and get over this idea of this being just a ploy. This is real. It is happening.
And the president's asking the American people for a long leash. And that's what's happening right now. And we'll see if the American people give it to him.
I do think it's going to be hard to avoid, further moves down in the market.
We went from stagflation in terms of people's thinking to recession in about 2 seconds.
I think tariffs are going up, and they're going to stay up for quite a long time. So it's not like a temporary supply disruption like we had during the COVID pandemic.
Obviously, some of our guests discussing the impact of U.S. tariffs on the global economy and the markets. Morgan Stanley thinks the growth drag from tariff uncertainties in Asia could be bigger than what we saw in 2018-2019. Let's bring in Chetan Ahya, Chief Asia Economist at Morgan Stanley. Good to have you this morning.
My pleasure to be here.
Been nearly a week since we got Liberation Day out of Washington. Seems like a lot longer than that. What's your first blush reaction to the impact it's going to have on global growth because of all the uncertainty it's caused?
So, we are out talking about the fact that there is a risk that we could see global recession. And for Asia, as you mentioned, what we are saying is that the damage to Asia's growth will be much more than what we had seen in 2018-19. So just to kind of recall, in 2018-19, Asia's growth had slowed by 1 percentage point. And in this cycle, we could see even more than that.
One thing that I find kind of challenging, well, I guess probably other people find it challenging too, but is that we've got the initial tariffs that have been announced, but then we also start to hear about negotiations, like Japan, for instance, is saying, and Israel, there's many governments that are already saying that they've reached out and maybe talks are even beginning. How do you also manage then trying to calculate the final amount of duties that you expect to see?
So firstly, I think that, if you just take a step back and try to understand what, Trump administration is talking about. So I try to listen to what Trump is saying, what Peter Navarro is saying, and what Steve Moran is saying. And they are all in sync. And I kind of summarize it for you as to what they think, what I think they want. What they want is they want to fix the U.S. trade deficit. They want to increase revenues in a sizable manner by putting in tariffs, and they want to onshore U.S. production. And so when you're talking about doing these deals, I think the most important thing for Asia to note is that they want to reduce trade deficit this time. So it's not just about reducing tariffs or removing non-tariff barriers. They are pretty much focused on reducing trade deficit that U.S. is running with Asian trade partners.
And if that is the case, then it's going to take some time. And we are not even clear that, let's say that Japan today has an agreement with the US that, yes, we will do the purchases, additional purchases, and reduce the trade deficit. It's unclear to us that the US will immediately reduce tariff. It might say that, yeah, let's see that trade deficit actually reducing, and then we will bring down tariffs.
So the time frame is what you're really pointing to that is causing this uncertainty, because shifting supply chains back to the United States, building out the factories in the United States, reducing the sizable record deficit with China, it all takes much longer than the time frame the Trump administration has given the world.
Absolutely, absolutely. And so I sort of remember from my experience in 2018-19, while we can keep talking about doing a deal, as long as the tariff uncertainty persists, it is going to weigh on CapEx cycle. So if you just think of any Asian producer, and Asia is the most trade-oriented, as we all know, they're all going to shelve their CapEx plans. And that tends to have a big impact on Asia's growth.
How do you think then central banks are likely to react? I mean, we've seen further Fed cuts being priced in. We had Deutsche Bank just earlier saying they're expecting a 50 basis point reduction from the RBA in May instead of 25 basis points that was previously priced in or expected. So do you think we see the easing cycle hastened?
Yes, absolutely. So we are already out saying that you should expect, about 50 to 75 basis points more rate cuts than what we have penciled in our base case, and we already have in the range of 50 to 100 basis points rate cut in our base case, and you should add another 50 to 75 basis point rate cuts that should come through. But look, I think there is going to be slightly different response for different economies. So for China, we are saying that it's got to be more fiscal policy because China's interest rates are already relatively low. Whereas for the rest of the region, you're probably going to get more monetary policy easing than fiscal easing. Ideally, I would like to see more fiscal easing because in times like this, when there is uncertainty, even if you reduce interest rates, people are not going to take the advantage of that low interest rate environment and do more CapEx. So the government needs to do the spending, and they should do fiscal easing. But unfortunately for everyone in the region, public debt to GDP has moved a lot post-COVID. And so, therefore, we are thinking that it will have to be monetary policy that lifts the burden rather than fiscal policy.
What's your assessment on China's vulnerability or, I guess, strength, if you will, facing these kinds of tariffs that could basically evaporate much of the trade across the Pacific Ocean? Are they in better position now because of their diversification strategies to South America, to Southeast Asia, Africa, and elsewhere? Or is it just as vulnerable because the local economy is still pretty weak?
Well, I think that considering the domestic setup that China is in currently, that it already has a big deflation problem. This development does make it more painful for China than 2017-18. I definitely think about it that way because at that point of time, we didn't have this kind of persistent deflation that China has already had. And look, I think the bigger issue that I am thinking, as we just mentioned about, is that the uncertainty causes a global trade slowdown. And so it's not about China's exports to the U.S., but if China were to be able to export to other countries by increasing market share and selling them new products and into these new geographies, it's possible when those economies are also doing well. But in an environment where there is going to be a global slowdown, their goods demand in other economies will also be suffering. So China is definitely going to have more pain to take this cycle than 2017-18.
We've been debating a lot about the levers that China can pull, and currency is seen as one of those. What are your expectations around yuan devaluation?
Well, at this point of time, I would think that China will not take up aggressive depreciation if it wants to do a deal. I think if there is a side or assessment that China makes that there is no deal possible, then they will have to let some currency depreciation happen. The reason I'm saying that is because one of the three things that they have referred, Trump administration has referred as an issue with trade partners, is tariff barriers, non-tariff barriers, and currency manipulation. So if Asian countries do resort to aggressive currency depreciation, I think that will reduce the chances of them doing a deal with the U.S. So I would assume that China will initially try not actively trying to pursue a much weaker currency. But there will be some gradual depreciation, and so we do have CNY going down to 7.5 by the year end.
Chetan, very quickly, what's the chance of a U.S. recession in the next 12 months or so, and global recession?
So we don't have U.S. recession in our base case, but we are highlighting that there is a significant downside risk as a result of these developments.
Right. Chetan, that was great to have you on this morning. That was Chetan Ahya there, Chief Asian Economist at Morgan Stanley. We'll have plenty more ahead. This is Bloomberg.
And welcome back to the China Show. We are looking at market reaction to the whole surfing of news that we are in headlines that we've been navigating this morning. Agricultural stocks in China in focus, no doubt, as Xi Jinping and Chinese leadership vows to fully unleash consumption. And as, of course, there could potentially be more tariff action against U.S. agricultural exports. We're seeing these companies as the broader market, the CSI 300, is eking out a gain so far of about 0.2%, but some bigger gains, as you can see, Annabelle, in some of these agricultural and seed companies.
Yeah, ag stocks one to watch. There's also a very interesting call out from Citi this morning, and they're saying that China's mature semiconductor names could actually become haven assets amid the tariff volatility, and that's because China's retaliatory tariffs on U.S. imports are making shares related to its domestic mature semiconductor names, especially analog, the most defensive in the market. So that's some of the movers there you can see, again, to the upside mostly. It's 11:29 a.m. in Tokyo. Japanese markets are just about to go into their lunch break. It's been an interesting session so far for the Nikkei 225 and the topics because they're advancing the most in the Asian region, but that was after they also led the declines at the start of the week. So some of the positive headlines is that Japan and the US are looking ahead to some sort of negotiations around the tariffs that are in place. And we're also tracking some of the names in particular. Japanese banks, for instance, are standing out to us this morning. And we are seeing, again, some moves here really strongly to the upside. There are also bets that are being placed of further easing for central banks globally as well. Nippon Steel, we're tracking this name in particular because this was a deal that was highly politicized during the US election campaign. It was sort of a will it or won't it happen, but essentially it was ultimately nixed. And now it seems like perhaps it could be back on the table once again. That is the potential sale of United States Steel to Nippon Steel.
And that's Trump essentially ordering a review of that. That was blocked by Biden, a $14.1 billion potential transaction. Bloomberg East Asia government editor John Herskovitz joins us now to discuss this. John, back and forth on this, different administration as well. How much of a change is this move from the Trump administration to open a review?
Sure. I mean, what this does, it brings back to life a deal which had pretty much been dead in the water. So the Trump administration is looking at this review for the Committee on Foreign Investment in the U.S. 45-day review process. This brings it back to life. Trump had a position in February after he met Japanese Prime Minister Ishiba that Nippon Steel would invest in U.S. Steel but not own the company, be a minority shareholder. On the campaign trail, Trump had opposed this deal. I mean, this is a highly political deal. This is one of the iconic companies of the U.S. So what had once been stopped was pretty much considered, no momentum towards it, now has fresh momentum.
But does it mean that the acquisition is going to be happening? And also, what shape could it take as well?
Sure. We don't know what the results are going to be, but it brings up the possibility that the acquisition could actually happen. Now, there's a lot going on now with Trump and Japan and the tariffs. Japan is one of the U.S.'s closest allies, one of the most important for Trump if he wants to bring pressure on China because of its proximity towards China. And yeah, if the deal goes ahead, it would be one of the most symbolic acquisitions of a U.S. company by a Japanese company. Whether it goes ahead or not is difficult to say, especially given what's going on with Trump trying to bring manufacturing back to the U.S. But there are some appearances of some concessions from the Trump administration, or just a willing to negotiate with Japan on some of these tariffs. The 25% tariff on the auto industry. Japan was hit with a 24% tariff on its exports to the U.S. And Japan has a relatively low rate of tariffs for the U.S. I think it's a 2.5% for non-agricultural U.S. items into Japan. So Japan is seeing a lot of unfairness in this relationship. So this is bringing some hope to the deal. And as we saw with the share prices are up significantly today because of this news.
John, good stuff. Bloomberg East Asia government editor John Herskovits in Tokyo. All right, I think we're just about to go to some live pictures of Kuala Lumpur, and that is Anwar Ibrahim, of course, there speaking at the ASEAN Investment Conference. We have headlines coming across from his speech. He says the global trading system is under intense strain. Malaysia will dispatch officials to Washington, D.C. ASEAN to send officials to Washington, according to Anwar Ibrahim. Also, ASEAN must rely more on itself and boost regional trade, according to Anwar Ibrahim.
Yeah, and just to note as well, Malaysia is the ASEAN chair this year, but also keeping it within Southeast Asia, where we're also tracking Jakarta's composite index that's just reopened. There actually was a trading halt that was triggered at the top of the hour, given the extreme amount of selling pressure. We're seeing it back trading once again, but it is still downside pressure. Indonesian markets were actually shut from March 27. So it's been a very extended market break there. And really, what news to come back to, because you think about what's happened in that period, and certainly Indonesia is as well facing levies from the U.S.
Yeah, that's right. So it's we'll have to see. Again, we'll have to check in tomorrow. This is, I guess you could say, an expected return to the market, given what we've had over the last 3-4 sessions globally. New Delhi has so far held back from retaliating against the United States for imposing 26% tariffs on Indian imports. Commerce Minister Piyush Goyal tells us New Delhi's duties on other countries are meant to protect the Indian economy.
I think our tariffs are a protection against these unfair trade practices. Or countries, let's take the RCEP region. Countries which cross-subsidize, which subsidize in one geography, move to another, and from there ship goods to a third. There are several ways which we are continuously finding. And it's like trying to remain abreast with new ways of beating the system. And a lot of our tariffs are to do with such protection against such economies. If you look at the United States, for example, while our overall tariff may be 17%, but a lot of it is products which we don't import it at all. Our applied tariff to the United States is probably 7 or 8%. It's not humongous. So really, it's a question of understanding India's tariff story. We've done an FTA with Australia a couple of years, 3 years ago, with UAE, with the 4 EFTA countries. We're in active dialogue with many other countries and group of countries. So we are a country that believes that bilaterally we can work together with countries which have fair trade practices. And then we don't need this kind of protection. Indian industry is very competent. They can beat any competition in the world if everybody sticks to the rules of the game. It's the irregularities or the unfair trade practices where we need to protect through tariffs. So I have absolutely no hesitation in saying that bilaterally we have a lot of elbow room in working with developed countries and countries where we find equal opportunity to do business.
You made a lot of reference to China. Do you see that trade relationship with China evolving? I mean, if you're laying the red carpet for the likes of Tesla, why not accept a company like BYD, which is looking for a domestic partner in India to do EVs?
Well, we need to be convinced that they will work by the rules of the game. And several unfair practices which are gradually coming to light as more and more companies come to us with what's happening, the kind of dumping that's happening in steel, for example. As we understand how they are doing third country subsidization, so country A is where the subsidy is provided, whatever you know which country I'm referring to. It goes to country B in the RCEP region, where they do the requisite value addition. It becomes simpler because the basic raw material is moving at very low prices. So value addition norms are easier to meet. And that subsidized product is being dumped on other countries like us. I mean, as these practices come to light, we have to be cautious in whom we allow to invest in the country. We have to be cautious about our strategic interests, our security interests. So it's a mix of many issues before we are able to take that decision.
So it's not a definite no for BYD. It depends on whether it can convince you.
As of now, it's a no.
That was the Indian Commerce Minister Piyush Goyal speaking with Bloomberg Insight anchor Haslinder Amin in Mumbai. And coming up, Samsung's quarterly profit gets a boost from its smartphones and chips as well. We're going to be digging into the firm's recent earnings next. This is Bloomberg. Welcome back to the China Show, taking a look at some of the major headlines that we're following this morning. And the Vietnamese Prime Minister is asking ministries and government agencies to work on Washington's concerns about non-tariff trade issues. The country is looking for ways to respond. That's after the US imposed 46% duties on some of its products. Authorities say Vietnam will push for more purchases of US goods. JP Morgan CEO Jamie Dimon is urging a quick resolution to uncertainties sparked by President Trump's tariffs. He wrote in his annual shareholder letter that the quicker the issue is resolved, the better, as negative effects increase cumulatively over time and would be hard to reverse. Days after Trump won the US election last year, Dimon said his tariff threats would get people to the table and that he hoped it would be done wisely. BlackRock's Larry Fink says most CEOs he talks to think the US is already in a recession. Speaking at the Economic Club of New York, Fink added that he also foresees more of an economic slowdown in the coming months with elevated inflation and a weakening US dollar. Despite the uncertainty, Fink believes that in the long run, the situation presents a buying opportunity.
Obviously, markets are down 20%. So some stocks are down over 30, 40% from their high water marks of just from January. But in the long run, I would say in the long run, this is more of a buying opportunity than a selling opportunity. That doesn't mean we can't fall another 20% from here too. But I do believe over the long run, the vitality of the United States will persist.
South Korea is sending its Trade Minister Chung In-kyo to Washington this week for talks with US Trade Representative Jamison Greer. The two-day visit will start on Tuesday, and Seoul is facing a 25% levy, among the highest duties to be imposed on a US security ally. President Trump has signalled he won't strike a deal to cut tariffs unless Seoul eliminates its trade deficit with the US. And taking a look at shares of Samsung today, because we had some earnings out early this morning, and actually we're seeing some positivity there, but pretty much in line with what broader benchmarks are doing this morning, Steve.
Yeah, the Samsung's quarterly profit beating expectations on the back of strong sales for its latest phones and legacy chips. Its revenue guidance was also above estimates. Bloomberg's Yulian Lee joins us now from Seoul. Yes, that gives Samsung Electronics a bit of momentum, but it doesn't necessarily address the bigger picture with Samsung, and that's trying to catch up with SK Hynix and the high bandwidth memory chips that fire the AI boom, obviously. So how do you look at these preliminary set of results for the short term and then the long term for Samsung?
Yeah, sure. So Samsung had been sending a lot of signals since the last quarter that the first quarter performance was going to be very, very weak. It was partly because of the U.S. export controls imposed on Chinese customers. So they were expecting this to be really impact their earnings in the first quarter. But as the numbers showed this morning, the top line, bottom line numbers came out better than expected. It's really driven by the very strong sales of S25, their flagship smartphone, which was launched in January. So, the first quarter is typically Samsung's strongest quarter for smartphone sales. But I think this, added AI features in the phone and, new slimmer design, all these things really help them sell their products. I think it took about 21 days to sell 1 million units of Galaxy phones in Korea, which was a record time. The previous record was with Galaxy Note 10, which was launched, I think, in 2019, which took 4 more days. So this has been a really big boost for them. But at the same time, the memory business fared better than expected. Largely driven by their legacy chips and as well as high-density DRAMs used in servers, which I think really offset the decline in the HBM sales slowdown.
I want to ask about the phones because, of course, the risk moving forward is with tariffs and Samsung already produces a lot of these in Vietnam. They're making some of their home appliance in Mexico, but Vietnam really stood out for the huge levies that are on that or will be applied to the country. So how do we know, or what's the sense so far of how Samsung is going to be managing this risk moving forward, and do they need to possibly look at price hikes, for instance?
Well, that's a great question. I think this has dealt a huge blow to Samsung. The 46% tariff on imports from Vietnam has been greater than expected. And, Samsung is the single biggest investor in Vietnam. They have their huge production base there. I think more than half of their mobile devices are produced there. So it is really, it has caused a lot of uncertainty for Samsung. Right now, I think they are trying to figure out, kind of assess the situation. I think the Vietnamese government is dealing with the U.S. government to really negotiate this tariff. So it remains to be seen, but it's really a cause of concern. And I think it's going to be really disruptive in their sort of near to longer term, performance assessments. So we have to really keep a close eye and see how it's going to be really, impacting their business.
Yulim, really quickly, you did talk about the legacy chips were a strong point, but where did they give a kind of update on their faltering efforts to really become a foundry player as well, as it relates as well going forward to the HBM chips?
Yeah, absolutely. Samsung is one of the only company in the world that has, different types of semiconductor business. They have memory chips, as we know. Together with Hynix, they dominate the memory chip industry in the world. And they also have foundry business with contract chip making, which is similar to TSMC, which they had a big plan to really catch up to TSMC many years ago. But the gap has been really widening over the years, and they're really struggling to find customers. So they had to kind of stop the production, factory lines, last year in the absence of customers, new major customers. So they're really facing a lot of challenges right there. I think analysts we have spoken to estimate that they probably lost 2 trillion won in the foundry and system LSI business in the first quarter. While maybe the memory chip business produced about 1 trillion won operating profit. So the bulk of the operating profit during the quarter, which was driven by mobile phones, which probably reported around 3 trillion won. These are all the rough estimates of analysts because today they are not really announcing divisional performance. So they really have a lot of challenges right now, and one of them being the foundry business. And of course, the advanced AI chip business, which is HBM. They are really struggling to catch up. But the managers are saying they're really trying hard to catch up in the second quarter of this year.
Right. Yulin Lee, thanks so much for joining us for the latest on Samsung Electronics out of Seoul. We'll have plenty more ahead as we wrap up the final few minutes here on the China Show. This is Bloomberg. And welcome back to the China Show. As China gears up for a fight, obviously, with the United States over tariffs, its social media users have attacked posts calling for Beijing to cede to Donald Trump's trade demands. Our China correspondent Min Lo is with us. What's all the fuss? I mean, because usually you'll have nationalistic sentiment prevailing, but then there are others calling for ceding to Trump's demands. What's the scoop here?
Yes, so there is this particular post that has been attributed to a money manager, although he denied making that post, but he pretty much said that China should surrender to the U.S. now because the cost is the smallest now, and the longer China drags its feet, the price they have to pay is going to be greater. And if you look at, can we show the other quote of that particular person who posted about? So he, not this one. So he had a pretty graphic way of saying it, where he talked about how, if you surrender now, can you show the next quote, please? If you surrender now, he says, that's when you have the most dignity. You do it standing up, raise your hand. But if you wait later, he says that you pretty much have to, kneel down. Okay, I don't know why they're not showing the quote, but you have to kneel down and kneel in the right posture, or you will, get another beating from the United States. So this was something that you can imagine got a lot of response from other people who are chiming in, very opposed to this post, very angry at this particular commentator, and they are very supportive, in fact, of what Beijing has done so far in retaliating against the U.S. So we have seen posts that some of those that you saw earlier saying that China is the largest producer of industrial products. It shouldn't be controlled by other buyers. China is going to fight till the end. And in response to what Trump has done, the additional 50% levies, there are people who are also commenting that, the U.S. doesn't want to sell us what we want. How is that going to solve the trade deficit? Just sell us the chips and then everything will be solved.
Okay, so I think we gave, and you've just given a bit of a sneak peek of the state media, but what's been happening, say, in the last couple of hours this morning? What's the latest right now?
Yeah, as we have talked about this multiple times, the Commerce Ministry came out to oppose some of those tariffs. They're still calling for dialogue, but they're saying that they're going to basically dig their heels in. They're not going to give in. And that's what we have seen from state media editorials as well. The Global Times published an editorial this morning that is saying that that the tariffs cannot intimidate China, saying that China's response so far has been very targeted, very calm and composed. And the approach behind that is because they are not looking to use these countermeasures to provoke the U.S. They are not trying to be confrontational here, but it's a declaration to defend that unfairness of all those tariffs so far. But at the same time, they're also not holding out any illusions that they could get a trade deal from Trump. And that is why that editorial is repeating what we heard earlier from what the People's Daily said, that to focus all their attention on doing its own things well to support the domestic economy.
All right, that was our China correspondent there, Min Lo, with us across the morning, because it has been a very big morning with China vowing to fight until the very end on these
and
tariffs.
No longer clinging to illusions, as Min just said. That's the People's Daily editorial today.
All right, the market reaction, well, we are just seeing stocks that are moving a bit higher here, but sort of in line with what we're seeing with broader Asian benchmarks this morning. That's it from the China Show.